Welcome back. We're going to talk about the Case-Shiller Home Price Index that was reported earlier today. We're going to take a look at some statistics that go along with these numbers and then a huge development maybe in the bond market. First off, Case-Shiller Home Price Index was up 0.7%, higher than March of 22. Seasonally adjusted, prices increased nationally 0.4% in March compared to February. We also talk about the 20 city composite. That's made up of the following 20 cities below: Atlanta, Boston, Charlotte, all the way through Tampa and Washington, D.C. That was down 1.1% from the 0.4% prior gain the prior month. Also, the All Transactions House Price Index is a broad measure of the movement of single-family property prices. It estimates price changes, mortgage defaults, prepayments, housing affordability. It's a very comprehensive number. First off, though, statistically speaking, we have the Home Price Index. Now, the Home Price Index, we see the last day since a high goes back 153 days. It means that if the market, we see right now, if the report, I should say, actually registers a higher high, that represents 153 days. We have to go back 153 calendar days in order to see a higher high. If it registers a lower low, then we would have to go back only 68 calendar days. It shows us that the bigger number indicates the more significant of a breakout or breakdown. The bigger numbers on the top, meaning the highs, which means that statistically speaking, we're trending higher because the highs are more significant. The 20 City Home Price Index, it's the same situation, 153-day high. All Transactions House Price Index, remember that's more of a comprehensive look at the housing market. That would be a 176-day high. Federal funds, we know, is sitting on very significant highs. The S&P 500 is on a 203-day high. Now we'll talk about the treasuries in just a moment as well, because that's pretty important. Home price index here is shown in yellow. Overall trend to the upside, coming off of those very big highs that were accomplished June of 22. June of 2022 is a very significant point in the charts. I'll show you why in just a second. The red histogram bars that were accomplished, this is January of this year, January 26th. That represents a 240-day low, which means if we break below the house price index, if it drops below 292, that would represent a 235-day high, which means that would put, or low I should say, that would put us at levels we haven't seen since January of the prior year. So we're going to watch these reports very carefully. So far, the home price numbers are positive. At least on the surface they are. But if we do break to lows, all of a sudden, this could look like a lot of trouble if we break below the January lows. And that's why we plot the numbers this way, because we want to see at what level things start to look very good or very bad. Now, we see the current levels. We're sitting at, roughly 150-day highs. But we really need to see a huge move up to break above this 300 level. That would indicate a much higher high. There's almost an identical chart for the 20 City Home Price Index. This reflects the home prices of the cities versus the national average. We could dissect these charts a lot further to see the nuances between the cities and the urban or the rural areas. But the charts are very, very similar. This is an All Transactions House Price Index. Interesting, this measures a much more broad-based look at the market, including the rates of prepayment, default, home affordability. This looks better. The more comprehensive number does look better than just the national average, or the 20 city composite for that matter. And by the way, speaking of which, we are in very significant highs. If we do break to new highs above 628, that would be extremely significant. But these are quarterly numbers. We don't get these updates very often. Compare the home price index in yellow to the to the federal funds rate in green. As interest rates go up, the home price index was going up, but then interest rates start to wear on the home prices and they started to fall. When did they start to fall? That magic number, June 2022. This is the home price index versus the S&P 500. Stocks were going up as home prices were going up. Stocks started to come down when home prices started to go down. Now stocks are going up and home prices are starting to go up as well. Now it's horizontal over here because the latest report we have is March. So until we have a new number, this will indicate a horizontal line. Now we plotted this way because obviously we know what the stock market has done since March, but this will update over time as well. Now we have the home price index versus the 1 and 10-year bond. The 1-year bond is in green. The red is a 10-year. Notice the crossover. The green line, the 1-year bond, crossed above the 10-year red line, which sparked the beginning of the inverted bond market curve. And that coincides with the top of the home price index. Kind of curious how these two significant points really matched up. That the top of the home price index coincides almost perfectly with the beginning of the inverted bond market. The inverted bond market occurs when short-term rates like the 1 year cross above the long-term rates like the 10-year. From a fundamental point of view, this tells us that the market, the bond market, the overall economy, everyone participating in the economy, net, it's telling us that the near-term outlook is more positive than the long-term outlook. Well, I think a lot of traders and investors that watch the bond market also watch the housing market, and maybe one is reacting off the other. But really curious how the two of these instances really line up. So we could use one as an indicator for the other, the home prices for the bond market or the bond market for the home prices. Now, speaking of bond markets, today's change in treasuries. If you've been following us for a little while, we talk a lot about the bond market, specifically the 1-year treasury note, the treasury bill, I should say. It has been very strong lately. Well, not today. Down 71 basis points. That's a pretty big move for such a short-term maturity instrument. The rest of the market, not so much of a move. The big move again, go back to our prior videos. You'll see how strong the 1-month T-bill was. Not today. Current U.S. Treasuries, this is how we stand now. A 5.31 on the 1 month. We were above 6%. The prior reports. 5.31. That's a huge sell-off. The highest yield we see now are in the 3-month, 4-month, 6-month bonds. The 1-year bond also seems to be catching up. Notice the disparity, the difference between the 1 year and the 10-year. The 1 year's at a 5.22, the 10 years at a 3.69. That is 100 and we'll see in a moment what 180 basis points. If we do our math correctly, this is a 1-month change in percentage change. Now this reflects a long-term move to the upside in the T-bills, but it's only up 16%. I believe this was up around 34% before today's bond market. This month in bonds, the dotted black line shows us the T-bills that were weak going back to the beginning of May, skyrocketed higher, registered a level of 6.02% May 26. Now down to the 520s. Notice the histogram bars, that's the stock market. Notice the rest of the bond market is pretty quiet compared to the T-bill at least. Now, the 10-1 spread, the 10-year bond is blue, the 1-year bond is red. Notice that inverted histogram bar, not 180, 153 basis point inversion. That is the biggest inversion we've seen since the beginning of this inverted bond market. We've looked at prior inverted bond markets in the year 2000, 2007. The most we saw at that point was about a 50 basis point inversion. This is 3 times that amount. That shows us a huge disparity in opinion expressed by the bond market between the economic outlook in the near-term future, meaning, well, will the Federal Reserve raise rates again soon? Probably. Long-term outlook, How does the economy look in the long term? Not so hot. Here is the 1 year, 10-year, and the 1 month. The 1 month T-bill is in black. That is a huge spike down. Notice the S&P 500 histogram bars registering very, very significant highs. Now, the reason why we're really focusing on this 1 month T-bill, we're going to talk about it again. Take a look at some of our prior videos. Specifically, we talk about the history of the inverted bond markets. What happens is during inverted bond markets, we have a couple different stages where we'll see the short-term rate spike higher. Here's the in 2007. The black line is a 10-year, the red line is a 1 year. Take a look all in the left-hand side of the charts. The 1 year's higher, but then the 1 year collapses. That collapse happened the latter part of 2007, and we know what happened with the stock market 2008. So it's very important to make note of how the short-term bonds move, and the short-term, we're talking about the 1 year, but even before the 1 year, it's the 1 month T-bill. The 1 month T-bill is a very important indicator when we're in an inverted bond market. So today's collapse, it's collapsed, but a huge sell-off on 1 month T-bills. This is something we should really make a very special note of. And we're going to talk about this a lot, in the days and weeks to come to see if this market follows through. But on the surface, the home price index looks strong. But again, this is under a cloud of a very perilous bond market, which is telling us a different story. We hope this has been helpful. We look forward to seeing you back soon.